You might be missing out on a unique opportunity in real estate right now, which comes around every 7 to 10 years. Last time this happened was 2008, 2009. The Federal Reserve has just lowered interest rates by half a basis point, which has marked a confirmation of the top of the interest rate cycle. And now we're seeing multiple cuts coming by the end of the year and into 2025 and beyond. Sellers with expiring mortgages are desperate, offering discounts of 20 to 30% off properties. So this is creating this dynamic where if you're a sophisticated investor and can read between the lines on which deals are the good ones out there, you can swoop up these deals just like how it was from people entering the market in 2010 to 2015. We all know after 2016, 17, 18, things got a little overheated. 2009 was when I first got started real estate and I rode this wave pretty well. And I've seen the same signs happen once again. In this video is tease out a couple of strategies that people are doing out there. Now, I'm not saying that one is better than the other. I think you as an investor need to decide which is for you. And it coincides with what markets you're going in. Let me bring up my table and let's dive into the details. All right. So here on the left side, you've got this more longer term strategy. And on the right side, you got this more aggressive short term strategy. I've got 10 different points I'm going to be going through. And hopefully, this really gets into the nitty gritty details as opposed to just, oh, I got a deal in my inbox. Looks like it's a good deal. The deal sponsor apparently says that it's bought at 20, 30% discounts. That's true for all the projects at this time. But which is the right for you? And first thing, investment strategy. The one on the left here is focused on stabilization and rent growth over time. I think a more prudent play, but on the right side here is aggressive value add with turn and burn approach, where you get in and out. One is more on the 5 to 7 year time horizon. The other one is a more riskier 3 year term, and where they're using a year or two of extensions. We call this the 3-1-1. So a sponsor may say a loan is good for 5 years, but it might be only good for 3 years. And then they're tacking on the 1 year extension, 1 year extension. It's generally pretty safe that you're going to get that extension when things correct so heavily. The extensions could be up for debate, meaning the bank may not give it to you. Just keep that in mind when you look at these deals. Whereas on the long-term strategy, you've got a fixed rate term, 8 to 12 years. I'm looking at now the number 4 line right here, 8 to 12 year term. I think everybody should pretty much feel safe. And the way to envision this is these terms on these loans in commercial world are a lot shorter than your 30-year loans for the residential, which is why commercial real estate went down so much. When you have this flash correction that stays for more than a couple years, few years, you have this situation where people are forced to sell in the downturn. Right now, on the residential real estate side, you have people prisoners in their own house. They don't want to get rid of their low interest rate loans. So people aren't selling. Therefore, you don't have people flooding the market or being forced on the market like you have in commercial real estate. But that's creating opportunities for us on the buy side. But again, what kind of deal is it? Is it more on the left side or the right side? Now, when you're looking at number 3 here, there's a moderate risk in these types of long-term stabilized strategies. You're going into tertiary markets. Tertiary markets are markets that aren't primary or secondary. Primary and secondary markets are the sexy markets. Primary markets are like Seattle, Boston, New York. Normally, we don't buy anything there anyway, and not even the short-term value add folks on the right side are doing that either. Mostly the short-term strategy folks are on secondary markets. So places like Dallas, places like Atlanta. For the long-term strategy to fully work, you've got to be more in the less sexy markets, the tertiary markets. The reason being there is the secondary markets and primary markets are always flooded with inventory. And boy, was it flooded post 2020. And I would say all the way up to 2023. Projects take about a year to two to construct once you get the shovel in the ground. So those projects that got started as soon as interest rates started to go up in 2023, they should be done in about 2025, 2026. So that's what's happening right now in the secondary and primary markets. New inventory is flooding the market, creating a lot of competition. Therefore, everybody's occupancy has gone down slightly, but the rents have stayed stagnant over the last couple of years. When things get back on, where are they going to start building? the secondary primary markets. Therefore, you have a lot of inventory coming online once again. It's the opposite story with tertiary markets. You didn't have huge building growth in these types of tertiary markets. We've looked at smaller markets in Georgia, whereas Atlanta would be known as a secondary market, which high inventory coming online. You're probably like, yeah, what kind of dummy would go into a place with a lot of new supply coming in? With that risk, you also come in with these are the types of markets where you have huge rent growth. Like in 2021, Phoenix had double digit rent growth year after year. Las Vegas is a great example of these markets that just get really hot, which we call cyclical markets. Cyclical markets meaning they go up and down, where these tertiary markets are a lot more boring, just linear growth. That said, you don't get lucky by rents exploding on you. But if that's not your strategy, I'm not saying the strategy on left or right is better. I think you as an investor need to decide which is better for you, but more in particular, how you're allocating your money to one or the other. You may allocate 40% of your portfolio to multifamily value add. Because obviously, we're not talking about development here. We're just talking about taking over existing properties. If for taking over existing the multifamily value add plan, maybe you want to do 10% of your net worth in short-term value add strategy so you can take advantage of these higher returns and be a little bit more risky. The other 20% of your net worth in the long-term stabilized place so you can sleep at night. So that's the way you have to tease it out. And that's why we say you always want to get around accredited investors doing this stuff so you can have these good conversations. Because most people out there are not even investing in any of this type of stuff. They're just in traditional investments. And I think whether you look at the left side or the right side, I think long term, multifamily, residential, real estate, apartments in the commercial world, it's an investment thesis that I like. It's lower workforce housing. In the long term, it's a asset class that's going to be going up in demand, especially with the bifurcation of the rich and the poor. The middle class are going to start to live more and more into apartments. And with immigration coming up, that's typically where immigrants and the lower middle class will live in these types of value living conditions. So we talked about the market. Again, tertiary markets, limited new construction, primary and secondary markets, you're going to be experiencing a high level of competition with new inventory coming online. Now, rent growth, we talked about that, moderate rent growth in these types of areas. Whereas your short-term value add strategy, you're putting your chips that you might get lucky with some good rent appreciation. Now, truly believe that a lot of these red states in the Sun Belt have a lot of good potential to grow. I'm not debunking the short-term value strategy. It's just maybe a little bit more risky than what you're seeing on the left side. This can go either way. Number 7 here, the upside potential, like what are actually going on in the property. You can have long-term stabilization strategies where you do a lot of renovations. I think this is where, as an investor, you need to really dig into what is the budget set for and the scope of the renovations. Are they just doing flooring and repainting the countertops and the cabinets? Or are they doing $10,000, $15,000 per unit for renovations? Are they just putting some cool pool equipment there? Or are they doing a complete overhaul of the clubhouse? Very different. And I think between these two, it's a bit of a wash. You could do one or the other. I think the biggest things is I don't think this number 7 line here really differentiates whether it's one strategy or the other. To throw another idea out there, you could be in a long-term stabilization strategy, which we've done in the past, just taking over a low income property. If you guys are familiar with Lure or Look programs, these are apartments developed with restrictions. And we happened to get into a project recently where the rents were undervalued by a couple $100 at least, and the restriction had burned off. So really there was very light renovations, but we're able to bump the rents up to market because that restriction of keeping the rents lower, 20% lower than normal, was completely gone. Same thing on the right side here. You could have a short-term value add strategy where you're doing barely anything to the units. It could just be a management play. That's a little tricky. It's a little harder to see back and forth. People want me to take a look at projects they're looking at. More than welcome to. I would probably just look at like the dollars amount because I'm a numbers guy. What is the price per unit of renovations? Anything less than $5,000, $10,000 is a little bit more on the light side. Anything more than that is a little bit more aggressive. Number 8, both projects could be stabilized properties, which is 90% occupied or more. With longer term agency financing, you need 90% occupied or better. This is why some people are pushed to the short term value add strategy because the property may be 89% occupied and they don't qualify for that. And therefore have to go the bridge loan route, which is, for example, that 311, which could be cut short at just 3 years. But it could also mean stepping into a 50% occupied property too. Thus, why you've got it at a better price, and thus why the value add potential is much bigger there with much more uncertainty. The long term strategy, obviously, you're going in with firm debt, typically agency financing, Fannie Mae, Freddie Mac, FHA. These are typically loans that are anywhere from 5 to 12 year notes. The idea is if there was a correction, you come out of the bottom of that correction. And if you think of that term, the way I visually think of it is like a ladder. If my ladder is 5 years and the market comes down and I want to bridge over that crater, my 5 year ladder might be enough to get over it. But certainly an 8 to 12 year long ladder would get over the top of that. And I'm not forced to sell or refinance during that period, which again, that's where you get caught. The short-term value add strategy have much higher returns, but it comes with the potential of maybe you did a good job. Maybe you got a couple years through the business plan. You got through value adding most of the units, bumping the rent. But if you're coming up on the last 12 years of your note and the market just happens to take a crap on you, if you go back to my analogy about that bridge coming over, you're not going to be able to bridge yourself over to that market correction side. If that makes you unwary, maybe you're just an investor more on the long-term stabilized side. But now we get into number 9 here, right? With that conservativeness, that lower risk, taking out a play of being screwed if your loan comes up for renewal and not having a long enough bridge to get you to the other side of the gap, you got to take a little bit lower returns. So how much lower? Is it negligible? That's up to you. Just comparing apples to apples here. Of course, all deals are completely different, going through a different sponsor splits, fees, etc. But again, I think this is what makes it difficult for investors. That's what I'm here to help folks to demystify. But if you take normal standard splits and fee structures out there, normally these long-term stabilization strategies are trying to double your money in 5 years, which I think might be able to do it a lot quicker. So like we talked about earlier, these deals being forecasted to be a little bit longer, but the market just went down 20 to 30%. If it even comes up half of that, you've already doubled your money as the investor. We're still using leverage in it. So a 10% bump in NOI already means we've doubled our money, right? Because we're levered. If you're just looking at getting a portion through the business plan and you're getting a little bit of traction with a recovering market, you could see getting to the business plan or maybe well exceeding the business plan in half of the amount of time. Back in 2018, we entered a deal where we went in and knocked everything out. Actually, we didn't knock everything out. We didn't renovate all the units, but we more than doubled our money. And I think we did a good job, quite frankly. That was getting a little trade winds from our back from 2018 to 2021. From an IR perspective, maybe in the low teens, but still, if you take 100% in 5 years, you average it out, you're hitting that 20% on average a year, which I think is pretty damn good. But this is where the short-term value add strategy touts much higher IRRs. And this is where I would say, be careful, right? A lot of this is marketing. And when IRRs get that high, it usually comes with some trade-off. Now you're playing in more primary and secondary cyclical markets. You've got a shorter runway here and you're somewhat exposed, but with that comes the possibility of 2x returns in 2 or 3 years. And this is where I would be wary of investors. Like when you start to see these types of words spout out, maybe it's just marketing. I try not to get there, even though the numbers do pencil that, because I just don't want to put that expectation out there. I don't want high expectations, right? I want to just do a good job and everybody's on the same team here. We're all partners and we all enjoy how the project goes, but I don't want to have to put a big number out there and put that expectation out. And the number 10 here, the market conditions. On the tertiary market type of deal, you have supply constrained areas with limited rental competition expected. With the correction, this is further elongated this timeline when there's not really too much inventory hitting these tertiary markets. So it's an untouched market in a way. If you're able to take over these projects, value added, maybe from a B class to A minus class, you're going to be sitting pretty well in an asset class in that market where there's not really new inventory coming online, right? Whereas the short term value add strategy, you're facing a lot of high inventory. Once things get rolling back again in 2025, these are the first markets that are going to get the new inventory anyway and new constructions. So I want to paint the picture neutrally. In those markets, the reason why the developers are going there is because the metrics for the market are good. The one thing I didn't talk about here was the age of properties. Generally, the long-term stabilization strategy plays are going to be your newer markets where it's built maybe 1990s, 2020s. So pretty new, right? And it can even be brand new right after development, where you're buying these things at a pretty good price. And that's part of the reason why it fits on the left side here. When you're buying those types of class A assets in a primary or secondary market, you're just priced out of the market. You're paying like $250,000, $300,000 per unit or more. If you guys are familiar with Grant Cardone, people have asked me in the past to break down that strategy. What he'll do is he'll buy class A properties, so built 2020s and later in these primary, secondary markets. And he's buying them at 300,000 plus per unit. The numbers never work on that. You really got to rely on a pretty heavy value add strategy and be negative cash flow in the interim, which again, if you're buying that type of new asset, there's not much you can do to really lift the rents drastically. Maybe you lift the rents $100, but that's like less than 5% when you're talking about average rents in the $2,000 range for a $300,000 per unit basis. Very similar concept to investing in properties in California or Hawaii, right? You might be able to value add those properties, but your holding costs are just going to be crazy because it's just too damn expensive there. So normally with the short-term value add strategy, you're buying in these primary, secondary markets, but you're buying properties that are older, right? Because that's the only way you're going to be able to compete for these properties is go after older assets, so class B and class C. And this is something I think we've been burned on in the past, right? Yeah, you do your due diligence, but when you have like a 1970s, 1960s property, things just break. It's like a 1992 Honda Civic. Stuff just breaks. And you have to account for that. When you're doing such an aggressive strategy, you just can't account for too much of these contingency plans because it's a high speed, low drag type of business plan. You can't keep an extra $2 million, assuming that the chiller might crap out on you 5 years earlier than expected. That happens with these types of older assets. Just maybe I'm tipping my hat a little bit. I think I've been personally beat up with that. So I think that's why we're focusing more on the newer assets, but the long-term stabilization strategy, more for what we've labeled here in the red, right? I don't want to be caught with a floating debt deal with a 2 or 3 year bridge loan. And I think some people are saying, yeah, that is a huge risk. I think everybody agrees that. Some people will say, let me put an interest rate cap to hedge the volatility. At that point, what you're essentially doing is buying a hybrid fixed rate term. You still run the risk. If the market corrects, you're not going to hit your debt service coverage ratio. Even if you have the interest rates in place, those are going to burn off at some point. That's not forever. It's not like an 8 to 12 year term. It may act like a fixed rate term deal while you have those interest rate caps on there. But at some point, and the risk is, again, it's all a risk. The short-term value add strategy. This way you've got this safety net, that safety net, this safety net. But maybe at this time, I'm just a little uncomfortable relying on the market correcting as much as it did. Because if it doesn't, then you're not going to hit your debt service coverage ratio. And the bank is not going to approve an extension. You have to decide which is better for you. If you need to schedule an onboarding call or you want us to take a look at a deal, that's a service that we're opening up for some of our members. There's a lot of deals out there. But again, I think when you look past the shiny pitch decks and pictures of the pool, then the 3-4 pages on the market, I think for new investors, it's really difficult to really tease out. And this is when we look at a deal, we pull up the industry reports, which are not accessible to passive investors. You guys don't have access to things like CoStar, Yardi, stuff like that. We're able to take a look at what the operator has done in the past, truthfully, not what they supposedly put on their website as exits and track record. And then we run the deal as we look at the deal. We run it through our own analyzer, do the P&Ls, the rent rolls. And then we oftentimes, if we get to that point, we do a due diligence physical inspection and then also walk the comps. Because a lot of what drives these properties is what you set your rental comp assumptions at. And you need to go there and physically verify that stuff to make sure it's on point. All things that we've learned in our past 60 plus projects. I think that makes us students of the game, always constantly improving and aware of certain things and gotchas. We didn't get too much into reversion cap rate. I think that's another thing as a new investor, you need to completely understand, because I think that's the biggest way that general partner sponsors fudge the numbers on the deal with that one metric. And that's covered in detail in our syndication LP masterclass. If you want access to that, shoot me an email, lane@thewealthelevator.com, along with any deals you want us to take a look at. What we're trying to do, a little bit different than anybody else, is we're not going to these fake it to make it operators with nice websites and are better at marketing. What we're trying to do is find the next level of operators who are already established that nobody knows about. They're quiet because they're head down operating and not really out there doing marketing and all that social media jazz. That said, it's hard to tell who's who, right? I think it comes down to the numbers and being able to put it to the analyzer. That's where it goes beyond the scope of most passive investors. When you get through the syndication masterclass, you start to have an awareness of this. We try to do is help people bridge the gap on that gap. And that way people aren't just going off of shill reviews, is what people call it, fake reviews and questionable track records on websites. At the end of the day, what I found is you never know unless you have a relationship with somebody. And I think that's what we boast as a community, where it's based on relationships. And at the end of the day, things are going to go up and down. I think the relationships and the integrity of the people that you work with are probably the most important things. If you have any questions on what we talked about today, hopefully that gave you a good overview on these two different strategies in the multifamily value add space. This does not take into account developments, which I would not put in any of these two categories. Now we're also looking at private equity deals, venture capital, things outside of real estate, which can provide better returns and potentially even better risk-adjusted returns. You'll find a lot of unfair advantages in the world of private equity. You have a smaller operator on the $1 to $20 million business size, just have a corner on the market. Those are the types of opportunities that we're trying to seek out. It all starts with that operator, right? Finding that operator. And that's what we've focused on here recently, especially for private equity.